Easy ways to use the recession to get rich. If you're watching this in 2023, this could be a once in a lifetime opportunity to build wealth because now could be one of the most accessible times to increase your net worth significantly. There's a famous saying that riches are made in recessions, and it doesn't take much to realize that we're already on our way to that point. Look at the headlines today. This could be a once in a generation opportunity to build wealth because now is one of the most accessible times to significantly increase your net worth if you know what you're doing. There's an adage that riches are made in recessions, and it doesn't take much to see that we're already on our way there. Look at the headlines today. More than 9 out of 10 CEOs are preparing for a recession, 97% of CFOs are cutting costs by 10%, and JP Morgan warns that the stock market could fall by another 20% from its current levels. Even though this appears to be a negative statement, the fact is that recessions occur regularly. If used correctly, it is possible to set yourself up for the rest of your life through incredible opportunities and discounts, with even Warren Buffett quoted saying bad news is an investor's best friend. So let's go over what's expected to happen over the following 12 to 24 months, the best benefits you can take advantage of right now, and precisely what you can do to ensure you're in the best position to make as much money as possible. You must first understand what you will be up against, and to begin with, we must discuss a recession. In general, recessions are accompanied by a significant increase in unemployment, a drop in wages, a loss in consumer confidence, and a decline in values across the board, including stocks, food, energy, and services, with sometimes far-reaching consequences around the world. Second, with a recession usually comes a drop in earnings. Companies report revenue and guide their future outlook every quarter. Still, they've been cutting forecasts recently, bracing for slow or even negative growth, and inciting recession risks at the fastest pace in 10 years. That brings us to the third point, layoffs. When consumers earn less, they spend less, and when businesses see less demand, they begin to cut back on their expenses, with employees typically being the first to go. A quick Google search for mass layoffs revealed dozens of companies all trimming their workforce. This video discusses how you can profit from the 2023 recession. Let's begin with stocks. All three major indexes are currently down between 20% and 30%. Analysts like JP Morgan believe we have another 20% to go from where we are now. However, since 1946, the average bear market drop has been close to 30%. The most severe was in 2009 when the S&P 500 fell 57% from its peak. Bear markets perform even worse during recessions with an average drop of 34.8%. All of this is to say that the absolute bottom usually occurs when we see investor capitalization. This is typically the start of the recovery, and things start to bounce back now. Housing. Even though each area is unique, some areas may continue to thrive. Housing declines on a national scale are extremely rare. In fact, over the last 60 years, there have only been a few instances where prices fell by more than 10%. However, the general Wall Street consensus now predicts that national housing prices will fall 7% with a worst-case drop of 10 to 15% if interest rates continue to rise. Of course, each market will be different, and according to Moody's Analytics, the most vulnerable markets could see a 25% drop from their peak. Parts of Florida, Arizona, Idaho, and Southern California are affected with a decline expected to last another 12 to 18 months before bottoming out. In the big picture, it's unlikely to make much of a difference for anyone with a fixed-rate mortgage who plans to stay in their home for the next 5 to 10 years. But for anyone looking to invest or buy a house, we may start to see some deals come on the market. Let's talk about money. There has been this mindset that cash is wasting away due to inflation. Still, when every other asset is falling in price, cash could be the safest place to store your wealth. And that's significant when billionaire Ray Dalio admits that cash is no longer trash. Many people forget that cash was the best performing asset as recently as 2018. And if you've only had saved in a high-yield savings account, you would have far outpaced the market. Cash has become such an important part of the portfolio that even fund managers have held the most cash since 2001. According to Citigroup, cash is the only asset investors can use as a recession hedge. However, if you genuinely want to become rich, you should take advantage of this hard-earned money. That brings us back to the beginning. Should you start buying stocks and investing? Even if a person believes that now is the wrong time to invest because everything is falling, 30% of the wealthy would see this as an opportunity to purchase those same companies. Warren Buffett had the perfect analogy for this as he stated, "When burgers go down in price, we sing. When burgers go up in price, we weep." Most people say about everything in life. They're purchasing everything except stocks. People dislike stores when they fall in value, so first, reframe your belief because a falling market may benefit you. Second, there is less competition. When times are tough, businesses cut back and play it safe. However, this allows smaller, more aggressive companies to emerge and take their place. For example, one study of 16,000 companies discovered that those who continue to advertise increase their value and get more bang for their buck with positive growth years after the recession. Patrick David made a great comparison a few months ago that the peak of the market cycle is precisely like a forest, meaning that only the largest and most established trees or companies have access to all resources or sunlight. In contrast, everything at the bottom has difficulty competing and growing. Like natural forest fires, our economy has a habit of clearing out and bankrupting companies that can no longer sustain themselves, creating opportunities for newer, smaller businesses to thrive. According to Yahoo Finance, historically 500 has fallen an average of 29% around a recession. With a median drop of 24%, but once stocks have found their low, their average return the following year is 40%. The market increased by 58% on average over the next 2 years. This implies that investing on the way down is far more profitable than exiting the market. Then here is Restructure, Reallocate, and Renegotiate. If you have any underperforming assets, you can sell them to pay off high-interest loans. For example, you could use the cash value from a life insurance policy, intra-family loans, or, in some cases, loans from retirement plans to pay off higher interest rate loans. If you qualify and have the time to apply, the SBA currently has low-interest rate loans with longer terms to help you manage your cash flow. You may also be paying too much interest because you don't have the correct credit score, cash flow reporting, and thus aren't getting the best deals from banks, collateral, or even the right connections, all of which can be changed. Loans should be restructured by using equity to pay off higher interest rate loans. I'd also like you to consider renegotiating your interest rates. Negotiating a lower interest rate with credit card companies is easier than you think. You can streamline, refinance even if you have a mortgage and want to stay with the same entity or organization. If you have a credit card, consider refinancing it into a car loan to lower your payments. Do you have a large amount of equity in your mortgage? You could lower your interest payments if you refinance it and pay off a business loan. If you cashed out a non-performing or underperforming mutual fund or certificate of deposit, then took that cash and paid off a higher interest rate loan, you'd be looking at a guaranteed return. Of course, you should stop making losses. You're not required to participate in the market's downturn. If you have an investment, you can set up a stop loss, which means that if the market falls by a certain percentage, you will automatically move to cash. So if you have retirement plans or stock market investments, you determine the point at which you are unwilling to suffer losses or deal with the volatility and remove the risk. Instead, invest your money in hiring employees and in yourself. You are your most valuable asset. Invest in your skill development and only in what you know. Moving to cash alleviates the mental stress that comes with a falling market. During this time, evaluate your skills and begin investing with purpose. Decide which investments make the most sense for you. Are you speculating or investing, creating certainty or gambling? What kind of an investor are you? And what investments make the most sense for you? The investment does not involve any risk. The investor has a stake in it. Stop relying on individuals who are more knowledgeable about sales than financial strategy. Stop handing over your money without a clear exit strategy, risk mitigation, or immediate cash flow. If you want to invest in yourself today, develop your skills and become more productive to be a part of the solution during these difficult times. And here is Recover Insurance Fees. It's time to get rid of duplicate coverages and bad insurance structures. Furthermore, you save more money when you only insure catastrophic events rather than insignificant ones. If you have enough savings, you may be able to raise your deductibles and drop short-term insurance. You could extend the elimination period on certain insurance policies so that they kick in later. To be more efficient, look for multi-policy discounts or consider using an umbrella policy and lowering your liability limits to the bare minimum. These modifications will result in lower premiums. You can reinvest that money in yourself to increase your liquidity or purchase more catastrophic coverage and transfer risk to the insurance company. If something disastrous occurs, they are responsible, not you. And lastly, put an end to tipping government. Your legal and ethical obligation is to save on taxes, so how can you maximize your deductions? Here's an excellent example. If you have a home office, you can deduct more of your vehicle's cost. Why? Because you're traveling from your home office to another office. You have even more reason to own that vehicle. What other ways can you maximize your deductions? Could you let your home to your company for 14 days a year? Smart business owners track every dollar spent on their company and assemble a tax team to help them maximize their deductions, making every dollar more productive. We won't know whether we're in a recession until it's over. We can't also predict when a market or asset will reach its bottom, so waiting for a specific moment is pointless. The best thing you can do now to increase your wealth is to analyze the available money opportunities on all markets and begin making long-term trades. Many millionaires are made during recessions because they are not afraid of negative numbers and use them to scale the money they have right now. And that concludes the different ways to use the recession to get rich. Did you enjoy today's video? Well, make sure to subscribe, share, and like this channel. Thanks for watching, and bye for now.